Interest rates are absolutely exploding, you guys, right in the front of spring home buying season. Thank God. And the housing market is starting to shift in the sense that we are finally getting demand. What we need, demand. We've had demand. We're finally getting inventory. And the name of the game, though, guys, is we need sustained inventory. And so, again, welcome back to Real Estate Mindset. Happy Friday. Welcome to another morning live where we get to act together as a community bonkers. We get to share our insights. So this is all for you guys. I wanted to also tell you guys that I am going to do a trivia during this video. So we're going to play trivia. I want it to be the Real Estate Mindset members versus realtors. So if there are any realtors that are watching us, please comment below. I want to start the trivia just as soon as I know that there are some realtors online. But we're playing trivia today. And if you're a part of our Real Estate Mindset community, I expect you guys to win. But the realtors might win, all right? So we'll do our trivia. But on top of that, I wanted to give you guys a heads up. I'm going to start my metro tours Saturday. I'm super excited. So I'm not sure if I'm going to be able to do a morning live on Tuesday. I will try to do that. If I do it, it will be in Dallas. I'm going to be meeting with Melody Wright, Danielle DiMartino Booth as well. Really excited about that, guys. It's going to be an extravaganza, in-depth, boots on the ground, eyes from the sky metro video. And we're going to cover way more than just new construction. Again, happy Friday. If you guys, any realtors online, please comment your realtors. Wanted to say good morning. If again, realtors, say something. We have a challenge to issue. There's Johnny. I love Johnny. Okay, good. All right, good. Get ready. Okay, we got one realtor. Good, good, good. Just let me say good morning. I want more realtors to say hello. There's my man, Jeff, Vegas, Nikki, Justin, I see you. And yes, it was, oh my freaking gosh, was what that stood for. WTH, Ray, Nikki, also Jeff. Really love you guys. Christy's here. Where's Charles? Is Charles here? There's Coors Light. There's Ima. Where is my man Charles? All right. Where are you at, Charles? Absolutely bonkers. There's Night Cry. Love it. Ruben, Johnny, see you, buddy. All right, guys. Oh, there's Sheldon. What's up? Dan, where's Dan Frio? What's up, Dan Frio? Happy Friday, Dan Frio. Where's Dan Frio at? All right. Anyways, guys, let's start with the trivia, okay? I just was hoping to see one more realtor, and then we're going to dig right into the mortgage report. We'll start with mortgage, look at a few videos. We'll go into real estate, look at a video, then we'll go into liquidity and recession like usual. I'll try to save some time at the end to answer you guys' questions and participate. Love you guys joining us, but I have a first question, okay? Realtors, step up, all right? Realtors, you should win, but I want to tell you as realtors, we have been talking like crazy in our Discord community, not all the time, but a lot of the time, and the Real Estate Mindset members are sharp. Okay, we're some sharp people in the community. So my first question before we really start is this, okay? So get ready. Okay, there's another realtor. We got some realtors. Another realtor. All right. All things, Nayli, you ready? Okay, realtors, you ready? Real Estate Mindset, you ready? Real Estate Mindset, here's the first question, okay? Whoever gets this first right, and I'm keeping a tally. What changes daily on rate sheets? What changes daily on rate sheets? What have I been training you guys to review as a consumer to lock your rate? What are you watching every day as a consumer trying to lock your rate? Not the 10-year. What have I been preaching you guys? What changes daily on the rate? Yes. Boom. He got it. Pricing. Okay. He's an investor. Oh my God. I didn't have a category for investors. Okay. That's right, you guys. Jeff, what? Well, see, the reason Jeff doesn't know is he didn't get a loan, so he doesn't need to know. Good morning, AJ. It's nice to see you. That's right, but we got a price, man. So we got a price now. Let me know if you're a realtor. If you're a realtor, comment below. But that's one for, I'm going to say one for Real Estate Mindset community. Unless we find out he's a realtor. Are you a realtor? Is he a realtor? The clumsy investor, are you a realtor? Is he a realtor or not? I don't think he's a realtor. Okay, so that's one for Real Estate Mindset, 0 for the realtors. Now, all right, you guys, I'm going to put my first timestamp here so you guys want to come back. Let's take a look at the 10-year right now. 10 years, 10 years going crazy, and I'll have some more questions for you guys, so be ready. So the 10-year, you guys, is plummeting actually this morning, dropped significantly. Some of us thought that it could actually potentially hit 5% or, a lot higher. No realtor. Okay, he's not a realtor. Anyways, but this has been going down. Part of the reason why it didn't keep going up because it blew up on Wednesday at CPI. But PPI came in basically as expected. I think it came in, what was that, 0.3, and I think it anticipated it was 0.4, I believe. So this has been going down. The market's like, oh my God, like how did it go up so high? This is what's killing the market. You guys remember, this is what's tracking and kind of manipulating the interest rates, okay? So let's take a look at the interest rates today. But before I go into the interest rates, I have one more question. Okay, you guys ready this time? I don't think you guys were ready last time. Second question, second trivia question, okay? Rem, let's keep going, okay? Ready? Here it is. What loan? This should be easy. Get ready. Get ready. What loan has the lowest, generally the lowest interest rate? What loan generally has the lowest interest rate? Conventional, FHA, VA, which one? What loan generally has the lowest interest rate? Boom, got it. Oh my God, I threw my pen and it hit me in the face. FHA, that's right. All right, so P Nice. We got a P Nice. Are you a realtor, P Nice? I don't think P Nice is a realtor. I see the real estate mindset community crushing this. Where you at, realtor? I don't even see a realtor answered this yet. Where's it? Look at how smart everyone is, man. I'm so proud of you guys. I am so no, not necessarily Sheldon, but there's possibilities. What was I thinking of? VA Land Board. VA Land Board has a lower rate, actually, if we want to get technical. So VA Land Board. But what we talking about is FHA. You guys are right. FHA. So let me show you guys what I'm talking about. So here's FHA right here. Here's VA. So VA is sometimes a little higher, but today, as you guys can see right here, and first of all, that's 2 for real estate mindset community, 0 for realtors. Okay, 0 for realtors. Right? I don't see you guys, realtors. Come on, realtors, you guys step up. I want realtors to at least get 2 points. Okay. But anyways, here's the interest rates for today, you guys, sitting at 7.37%. That is astronomical, obviously. Here's 30-year right here. Here's a 30-year FHA. FHA is sitting at 6.75. You guys can see VA also sitting at 6.75. We've seen this at many different occasions to where it was 1 basis point over FHA. So it's basically the same as FHA usually. Sometimes a little higher unless it's a land board loan. Now, the 15-year is 6.82%. Notice that both FHA and VA are under the interest rate of a 15-year mortgage. Like, think about that for a second. Pretty crazy. Anyways, guys, so I have a little bit of a harder question, and then we're going to go into the See Me Fed Watch. So and then we're going to take a break on the questions for a little bit. But I have our third question. Third question, you guys. Okay, so get ready for our third question. Again, Real Estate Mindset is doing a phenomenal job. This is going to be our next data set. This is insane. I'm going to show you this in a minute. But our next question is, what generally, because this is such strong specificity, so it's all general. We can't really make blanket statements. Generally, why is a broker cheaper? Why generally is a broker cheaper? Why is it usually cheaper to go to a broker? Why do you usually get a better deal going to a broker? Because remember, I've been preaching about this. Shop your mortgage. Make sure you're following up with a broker. Generally, a broker will give you a better deal. So no, not yet. They shop rates. No. More options. No. Less regulation. No. There it is. My man. Yes, dude. And he's not a realtor. He's not a realtor. We got another one for Real Estate Mindset community. Okay. They got lower fixed costs. So remember, you guys, generally brokers have a much lower operating expense. Direct lenders, generally, they have offices, they have employees, they have in-house processors, in-house underwriters. They have to pay for all this paper, all these lights. And then, because of that additional operating expense, and I've been a branch manager of 3 branches, so I could tell you this is how this works, they pad the interest rates. So I say I can get someone, I'm a branch manager, I can give someone a 4%. But my expenses are really high. So instead of giving someone a 4%, I have to give them a 4.25% because as a direct lender, I need to make more money to operate. Now, the disadvantage, so good job. Man, I am so proud of you guys. So again, that's not always true. You guys definitely do your shopping. Let's go to the See Me, but it's mostly true. I'm going to tell you that right now. But the disadvantage is generally the service is a little bit more like crappy. Generally, it's more crappy. Anyways, moving on to See Me Fed Watch. This is freaking amazing. This is the worst it's been. Well, the best for us, but I've been like cheerleading and praying, like, please, elevated interest rates. We need it for spring home buying. If we don't have it, it could be trouble. Look at guys, this is all the way to December. Okay, so now this is the highest it's ever been since we've been covering it. Now the market is saying no rate cut, 9.1% chance. First of all, they're always wrong. Now, again, Remember when I did a video with Jason Walter, I said we're probably going to have rates near 8% starting the year, high 7%, right? But if we have an economic recession happen, and if it's by this year, then the rates will drop. So now that the market is pricing in no rate cuts, it's probably going to have something bad happen. That's what I'm thinking is going to happen. I'm not going to bet on it, but that's what I think is going to happen. Look at that, guys. 9.1%. Insane. And when we go to January of 2025, look at this. I'm going to go even further. Even January is pricing in no rate cut in 2025. 6.4% chance of no rate cut, even January of 2025. Look at March. They've changed this a lot. This is crazy. My gosh, man. Even March, you guys, the market doesn't know. First of all, this is why the market's like, we don't know anymore what's going to happen. Even though Jerome's like higher for longer, he went to Congress and said higher for longer. So even though he said that, the market is still like, we don't know what's going to happen. What's going to happen? You guys, March 2025, 3.5% likelihood that we have no rate cut by March of 2025. Personally, I think that's interesting. Maybe, I don't know, guys, maybe we have runaway inflation. What do you think? What do you guys think? We have runaway inflation? Anyways, let's move on to the amortization schedule real quick. I want to show you guys what a 7.37% looks like. Remember, a mortgage is a death contract. The reason is, and I'm going to just break it down like this. The reason is you pay all the interest before you pay your principal. Look at year one. Year one, you guys pay, okay, first of all, this is on a $324,000 loan based on today's interest rate. Year one, okay, all your payments you pay for year one, $23,000 is just interest. Let me go down to year 29. To put this in perspective, year 29, only $2,869 is interest. The reason, remember, is it's front-loaded. The amortization is front-loaded with interest, which means, okay, based on today's interest rate, if you guys drop your balance from $324,000 to $306,000, so about $18,000, basically you guys pay $18,000, you save $110,000 in interest. And the $18,000 that you pay is still your money. You get it back if you sell the house because you're just paying your loan down. It's not like you have to pay an $18,000 fee to save $110,000. You don't. You just need to save your money, put it in your mortgage for a little bit, and you save $110,000. That is how these amortization schedules work. It's insane. Now, look at guys, first of all, I think every one of us should own a house, okay? Every one of us should own a house. Owning a house can be a great, great thing for American families, for Americans. It is great. I love it. But right now, horrible time, very toxic, bunch of liars, bunch of fraud, bunch of corruption, all prices ran up, okay? So in other words, it's just very, very, I'm sorry. It's just so dangerous. Come on, guys, slow down, right? Slow down. Seriously, slow down a little bit. But anyways, guys, you pay sorry. We get picked on a lot because they're like, oh, you pay 100% in interest in renting. You pay, and I get it, right? But the thing is, guys, is if you buy $324,000, if you get a $324,000 loan, the total amount of interest you pay is $481,000. All right, that equals 148% in interest. But yes, I understand we pay the loan down, $3,000 at a time. We only pay the loan down. Look at $3,000 every year. That's people are like, well, you're going to build your equity. Well, we're only paying $3,000 down a year on the loan. So my point is this: is yes, owning a house is great, but don't let these people bully you. That's my point, because they're paying 148% in interest. We're paying 100%. Plus, I'm taking my lower monthly payment and I'm saving even more money. I was just talking in our Discord. What I'm trying to buy, I'm not trying to buy like, new shoes and like, all these things. I'm trying to buy T-bills. I'm trying to save up my money to buy my next round of T-bills. I love T-bills. It's, risk-free for the most part. I'm not giving financial advice. Now, first video we're going to go into, hopefully you guys are hanging in there. Realtors, we're going to ask questions after we get back from this video. So I want the realtors to step up. It's 3-0 real estate mindset. Okay. So our first video is going to be about runaway inflation. And I want to ask you guys, honestly here, do you think interest rates should have been higher? That's not the trivia question. That's just my question to you. Do you guys think that interest rates should be higher? Here's our runaway inflation video.
Schutte, he's Chief Investment Officer with Northwestern Mutual Wealth Management. Brent, welcome. Good to have you back. As we talk here, and I believe one of your thesis is that it may be difficult for the Fed to cut rates maybe at all this year Love to hear you elaborate on that. But so we're in this higher for longer phase. Was the mistake here that the Fed didn't go even higher?
I don't think so. I just don't think inflation is dead yet. And that's why we've had this consistent belief for the past few months, despite the narrative to the opposite, that inflation is not coming down. It's actually reaccelerating. Yep. And you're seeing that across various segments. I think the market has ignored it because they want to latch onto the soft landing. And Chair Powell has ignored it just a bit too, because I think he wants to latch onto that also. Look, nearly every inflation measure over the past few months is moving up, not down. The longer rates stay elevated, the more they work their way into the economy. I think the mistake we all made, or at least a lot of us made, was that we thought because there was a quicker tightening cycle, the economy would fall more quickly into a recession. That's not been the case because the consumer has had excess savings. A lot of consumer debt is in fixed rate mortgages, which haven't repriced, but you're seeing it start to impact lower consumers. You're seeing it start to pile up on auto loans, auto loans, credit card debt. You're seeing increased delinquencies there. And so to me, the inflation narrative is the most important narrative. And I don't think the Fed is going to be able to cut aggressively enough to lower rates. And again, the longer rates stay higher, the more the economy reprices. And we're only 2 years into this post the original tightening. On average, it's taken 10 or 2.5 years, with the longest being 4.
So let me come back to you. Cutting rates is not a strategy for tightening down on inflation. The opposite would be true. So what do you recommend for the Fed if the Fed is hell-bent on getting inflation down very close to 2%? What is their next best step?
I think right now to stay the course and not lower rates. Look, I think the bar is high for them to raise. They've made some mistakes in the past. I doubt they want to have an egg on their face and actually start tightening rates, especially before an election.
And they have also they've said expressly that they believe that the peak in this rate cycle has been hit.
100%. And so I think the bar is high for them to tighten. We'll see. Look, I think the bottom line, and I keep coming back to this, is we're late in an economic cycle. We can all try to guess the timing of a recession, but I think we can all agree the unemployment rate is low. The wages are high. They've come down, but they've stalled out at 4%, which has historically been the top of what the Fed likes. The Fed likes that at 3 to 3.5%. I don't think there are a ton of new people to come back into the labor market, and inflation is stickier in that scenario. And so as an investor, you need to think end of economic cycle, not going out and taking a bunch of risk, or at a minimum, just making sure that you're taking risks that you're comfortable with.
Okay, so you lead me to our next question. Let's get to the news you can use. If you're an investor and you want to make some hay in this volatile time, some rocky road in getting inflation down and the guessing game around interest rate hikes or cuts, how do you invest right now, and who benefits?
I think the key word is investor. Are you a short-term investor or are you a long-term investor? Look, days like yesterday could continue. You saw the market falter. You saw bonds falter quite a bit, but bonds today yield 4.5 or 4.55. I think you saw in the introduction of the 10-year. The Barclays or Bloomberg Aggregate Index yields over 5%. I think any investor should be happy moving into fixed income in these environments because the yield is high, and who knows what the next 3, 5, 7 years bring. I think the Fed will be able to cut rates aggressively once we do see kind of that last inflationary impulse burn off. The other thing, unfortunately, is I think people are being drawn to the mega cap story. So if you think about it, the commentary goes, these are economically insensitive, they're longer term, they're higher quality, and therefore you should invest in them. And on days like yesterday, they outperform. The question you have to ask yourself is, how much do you pay for that quality? And the other economically sensitive stuff, how well have they not already done because people have been not buying them on days like that? I think that narrative shifts. And so I think about investing through and on the other side. And I think small and mid cap, while not an instant gratification trade, I think if you're an investor, you will be happy you were buying those during this time period in the next 2, 3, 5 years, as well as even equal weighted S&P or things that are more broad in nature, because the market advance has been pretty narrow. Things like small and mid have not been bid up. They're still below their all-time highs, and they trade at historically low valuations, just given the fact that people are aware of this, but they're gravitating towards those mega caps, which are economically insensitive, which I think will become economically sensitive. And then people will wonder, why did I pay this much?
Why did I pay this much? And that's what a lot of buyers are asking themselves. And I just did a video about the buyer's regret, which is over 90%. So I guess 10% of people are doing it right when purchasing real estate. The other 90% are using their emotions, probably. Who knows what's really going on? We can't really trust anything. But we're going to move on to our real estate update, guys. I'm going to go over an article it's going to show you guys the top, and this is really surprising data. It's going to show you guys the top 10 metro areas with price decline for listing prices, because remember, the listing price leads the sales price. So I'm going to show you guys the top 10. I'm also going to go into another appraisal. We have a third appraisal. So I think we've reviewed 3 appraisals in a row, which is so cool. I love appraisals. And then I'm going to review an HOI, a homeowner's insurance. We call it HOI in the industry. So HOI, homeowner's insurance policy. Remember, I got a non-renewal. So I wanted to warn you guys on what insurance providers are doing right now, because it's freaking crazy. And I've never went through anything like this. So I got some warnings for you. But trivia, question number 4, realtors, get ready. Okay, I already know the real estate mindset's already ready. I see you guys already ready. Realtors, all right, I'm buying some time for you. Get ready. Here's our next question. I want some realtors to win, man. All right, question number 4. Okay. This is important. What do you analyze on a local level to know if you're getting a good deal? Generally, what do you analyze on a local level to know if you're getting a good deal? Scrog, I miss you in Discord, brother. What do you guys analyze on a local level? No. Well, yes, but what? Where are they located? Where are they located? Where are they located? What do you analyze? Yes. Here we go. Boom. Where are you at? Oh my God. Here it is. Vegas. Did we get it? Is this the first one? Yes. You guys were killing them. We're killing them. Where are you realtors at? Come on, realtors. Yeah, subdivision. Now, if it doesn't have a subdivision, yes, proximity, but it's generally subdivision. You guys are nailing it. You guys remember, like when we look at Redfin, that's, for lack of better words, that's all macro data. Even if we go into like Kingwood City, it's still macro data. You got to go subdivision. You got to analyze a subdivision if you're going to understand whether or not you're getting a good deal or a bad deal, or just what's going on with the trends in your area. Remember, every subdivision is different. Okay. Remember that. Good job, guys. Very, very good job. Now, 5th question here, realtors. And I saw some people answer this already. Actually, this is funny. Generally, how many comparables are used in an appraisal? That's funny, Johnny. How many comparables are used in an appraisal generally? Sold homes. How many sold homes are generally used in an appraisal? How many sold homes, guys? Is it 10? Boom. Got it. Nailed that right there. 3. That's right. Now you'll find more comparables, but sold comparables needs to be 3. The reason why that's important is because remember, just one bad comp can mess up the entire subdivision. 2 bad comps could ruin it. 3 bad comps, it's dead. So remember, guys, there's only 3 comps are in a subdivision are generally used for an appraisal. Man, you guys are just killing it today. All right, let's go into our analysis now. I want to give you guys some warnings, okay? So we're going to pull up an appraisal. Let me just throw this on the screen for you, okay? Here's another appraisal, okay? So this is our 3rd appraisal. This is a recent appraisal, and a few things that I want to give you guys a warning about. Now, you're really going to want to be warned on what happens here when you're refinancing. Generally, you really need to focus on refinancing. When you do an appraisal on purchase, the difference is the appraiser gets a copy of the purchase contract. So the appraiser knows that there is someone willing to pay that purchase price for the house. And so they have a target. But that's also stupid, and they are lazy. Okay. And this person was lazy. But when you refinance, they're even lazier and they have no purchase contract. Okay. So this also works if you're fighting your assessed value. Now, let me move myself out of the way so I can kind of give you guys a really deep dive right here. Okay. So remember, you guys, first column, this is our subject property where the star is. And this is comp number 1, comp number 2, comp number 3. Look at, you guys are so smart. Telling you guys are some of the best buyers in America. And you guys aren't even licensed, man. I'm telling you guys are geniuses. You guys are so smart. All right. I'm going to calm down. Okay. I'm going to calm down. Now, first thing is this is what I want to warn you about on MLS. Okay. On MLS, this was listed, okay, at 3,000, I think it was 23 square feet. Okay. So again, and you guys want to watch your appraisal. This is why I'm telling you this. So the buyer thought that they were getting a house that was 3,000 square feet. All right. Now, remember, the appraisers are generally required to remeasure the house because they know the county records are often wrong, especially in Texas, and they know that sellers often don't know. So this person thought they were getting a house for 3,000 square feet. When the appraiser went out there to measure, it came at 2878. Okay, so they lost about a little less than 200 square feet. That's really bad because especially if he was looking for wedge. Okay, so the first thing I want to warn you guys about is definitely, if you guys are doing appraisals, make sure you monitor what the GLA is, which again, remember, GLA stands for gross living area. That's your livable square footage. Okay, so again, watch out for that because you can't trust the MLS. That's what we need access as consumers, but we can't trust the info on MLS because the info is only as good as the person that is inputting that info. And whoever input this info put it in wrong. And the only way that they found out about that is by spending the money on an appraisal. Okay, now here's the other thing, you guys. I want to make a point. Which comp is the worst comp? Okay, now first of all, if we just look at distance from property, which is, I'm going to circle. So distance from property is here. I'm putting little circles by there. Okay, so the first comp was 0.2 miles. Okay, so right next to it. Second comp was 0.38, so about half a mile. And then the third comp was 0.04. So comp 1 and comp 3 were close to the house. Comp number 2 was the furthest away. And what you'll notice, look at comp number 2 also sold for the lowest price per square foot, which means comp number 2 is bringing down the value. Okay? It's bringing down the value. Now look at the three values that we have here. Okay, so the first value we got was 389. That's really good. Second value of the crappy comparable was only 342. That is a discrepancy of $45,000 because comp number 2 is way bigger. And remember, when you are dealing with way bigger houses, generally it's less per square foot. So that comp 2 was way further away and it's a way bigger house. It's bigger by about 500 square feet. And so it's bringing down the value. And the third one was 348,000. All right. Now, here's the other thing I want to tell you guys about. Okay. So always watch your gross living area. But this appraiser was lazy because this property, guess what? It has a pool. Okay. See this right here? See this little row that says fence and pool? Okay, so my subject property has a pool, but look at, the guy made no deductions on the comparables for the pool. Look at this. He made no deductions for the pool. And I know what you're thinking. Well, that's because probably the comparables had a pool, right? Is that what you guys are thinking? The comparables had a pool? They didn't. That was the first thing I checked. The comparables did not have a pool. The appraiser should have done their job, not been lazy. But what happened, guys, is they saw the purchase contract. They knew what they had to get. When they got it, they stopped. And that is wrong because the customer wasn't my customer, but the customer paid money to have an accurate appraisal report done. So I don't care that they hit the purchase price. They need to finish their job. And that appraisal withheld pool deductions. And that's not right. Okay, so that is that. Okay. Also, guys, it's 5-1 for the trivia right now. You guys are nailing it. Now what I want to do is I want to show you guys, look at this. Okay, here's my homeowner's insurance. So remember, I got dropped. And okay, people get this confused. I am renting, but I also own a house. It is what it is, guys. It's a long story on how I got into the situation. But I own a house, but I'm renting, looking for a primary residence, okay? So now that we are clear with that, let me explain what's wrong with this picture. Now, the first thing is my house, first of all, okay, it's worth, where can I write this? It's worth about, oh my gosh, that didn't work out well for me. Here, let me do this again, okay? So my house is worth, let me put it right here, about $425,000, okay? Here's the first thing wrong, and here's what's going on that I need you guys to be careful about if you're shopping your homeowner's insurance. They are jacking up the dwelling coverage on us. Look at this. They will not allow me to get a proper dwelling coverage. Why do I want to pay insurance for $600,000 dwelling coverage when my house is only worth $425,000? I have the answer. I don't want to do that. In fact, I keep asking them, please lower the dwelling coverage. I don't need $600,000. You're crazy. I don't want to pay too much. And they're like, sorry, we have to. You're in Texas. I'm like, how dare you? How dare, they're like, the cost to rebuild is going up. I'm like, but lumber's going down. I'm watching this stuff like, how dare you? You guys be careful for that dwelling coverage. They will jack that up on you and increase your premium. But here's another thing. Look at this, okay? I told you guys I've been shopping my insurance. First of all, my insurance was $1,500. My insurance was $1,500. The lowest quote I got, and this is another thing you need to be careful about, all right? That's the lowest. So first of all, I went from $1,500 to $2,400 roughly. That's the lowest quote I got, $2,375, okay? But here's the thing. My first question to Shara, my wife, who was shopping, was, what's the deductibles? Okay, so your dwelling coverage and your deductibles is what you need to pay attention to. If you don't pay attention to your dwelling coverage and your deductible, you don't know what they're doing to your plan. So when I asked her about what are the deductibles, she was like 5 and 5. And I was like, 5 and 5? What? Right here, look at this, okay? Look at my deductibles. Normally people like want 1 and 1 or 1 and 2 or 2 and 2, but 5 and 5 is freaking nuts. So I was like, we can't take this policy. Even though that this policy is cheaper, it's not coverage, okay? Because 5%, so my deductible is 5%, which is 30. Look at this, freaking nuts. Because I'm paying 5% on this. I don't want to pay 5% on that. I want to pay 5% on the 400,000, not the 600,000. So I was like, oh, it's my deductible is $30,000. So it's not coverage. My roof, to replace a roof is less than 30,000, depending on the roof and the type of damage and the type of repair. So I was like, this is not real insurance. So I almost was sold on this really low amount. But when I look here, the coverage is way too high and the deductibles are 5 and 5. Awful, terrible, terrible, terrible stuff. You guys do not want 5 and 5. Jeff M, I bet you have insurance, don't you? What's your deductible, Jeff M? I want to know what Jeff M's deductible. He better have a 1 and 1 or 2 and 2. If it's anything over 2, you guys are in danger. I'm telling you. I'm not a financial advisor. I'm just saying, okay? So just be careful on that. Now, I got some crazy stuff for you guys now. We're going to go over the top declining, as they say, metro areas. Okay? Where's Jeff at? Jeff, all right, Jeff is going to check, okay? You guys let me know when he gets that on there, okay? So Jeff is going to check. I'm going to tell you right now, I'm going to guesstimate. He's in a more affordable-ish area. It's got to be 1 and 1. It's not higher than 2 and 2. It's not higher than 2 and 2. Jeff's got 1 and 1 or 2 and 2. I'm calling that right now. All right, let me throw up this next stat for you guys right now. This is insane. Okay, take a look at this, guys. All right, he's going to go check. I'm going to kind of look down, see when he gets back. Now, this is from Banking Rates, okay? Came out 3 days ago. The name of this article is Housing Market 2024. I'm going to go through this very quickly because I hate reading when I'm live because I suck at it. Home prices are plummeting. I was like, what? Where's everyone roasting them for using the word plummeting? When I use the word plummeting or skyrocket, people are like, you're an evil person. Your value doesn't matter. It doesn't matter. You're offering all this stuff for free. You use the word skyrocketing, so you're evil, Travis. And I'm like, please don't say that. It hurts my feelings. Anyways, guys, this is insane. Plummeting in 10 formerly overpriced markets. Is Jeff there yet? Jeff's not there yet. Okay, so take a look at this, guys. We're just going to look. Now, this is listing price. So this is listing price leads sales price. Okay, so this is shifting. This is what I'm showing you guys. The market is shifting. We need it. We need more time. I'm sorry for yelling. We need more time. It takes time. But these are crazy, crazy metro areas right here. Okay, I don't see Jeff yet. All right, so number 1 is Portland, Oregon. The median list price, this is the list price. This is what they're trying to sell it, is lower year over year, which is good because that is leading prices going down, right? Year over year list price being lower is great. It's a shift. Thank God this is what we needed in 2023, but we didn't get it in 2023. It started in 2023, but instead of the higher rates, we got the Bank Term Funding Program. It is what it is. Number 2, San Francisco, California, down 1.3% year over year. Fascinating. San Antonio is down 1.5%. They're also down 1.3% for actual sold prices. So we have a double whammy in San Antonio. Look at Raleigh, North Carolina, down 2.2%. This is very interesting, 2.2% year over year. And also San Jose, which is one of the leading metro areas, depending on what source of data you look at, is also down 2.3% year over year. Then we got to go through all these advertisements. I don't know. For a minute there, I thought we were on Dave Ramsey's website because of all these advertisements. You guys get it? Please don't roast me. I just don't like him. I really don't. I made a video, you guys. Oh my God. I made it. And you know who else I need to make a video about? Pace. That dude just did a video on how to help people that they do a subject to get financing in the future. And when I'm listening to the video he's doing, he's like, I'm saying, I'm like, this guy is recommending people commit loan fraud. You can't lie to a lender and say you're renting a house out to someone when you just bought it subject to, you liar. And then you want him to sign a federal paperwork. Are you freaking out of your mind? Someone needs to shut that guy down. Anyways, guys, Denver, Colorado, big time down 3.6. So I would be keeping my eyes on this area since these are the leading into price decline. Isn't this crazy, Jeff? Look, Kansas City, Jeff, this is crazy. Where's Jeff at? This is crazy. Kansas City's down 4.9%. What? Cincinnati, Ohio down 6.4%. Huh? I guess those interest rates are finally starting to catch up. Oklahoma City's on here, 7.4% down year over year. Look at the last one. This one hit me by surprise. Miami, Florida. Super strong Miami, Florida. Median list price is down year over year, 8.2%. You guys, 8.2%. That's big news. I know we have to be patient. What's going on with my camera here? I know we have to be patient, guys. We have to be patient, but that is a good sign, right? We didn't have that last year. Everything reversed last year. Don't forget that. I don't see Jeff. Where's Jeff? All right, we're going to go on to our next video right now. Our next video is basically why insurance is skyrocketing. Okay, so and when you guys are listening to this video, understand that there's two things going on. Not only is insurance skyrocketing, but remember, property tax is also skyrocketing. So as consumers that are homeowners, we need to take advantage of shopping our insurance, filing our residential homesteads to save money on our taxes. And the biggest thing of all, protest your assessed value. Every year, I don't care if you have comps or not, just go through the motions. If you go through the motions, usually they give you a discount. We're going to go into our first video, y'all. This is on why the skyrocketing insurance. I hope you enjoy.
Brutal inflation numbers in this morning's report coming from insurance, home and auto insurance spiking for millions of Americans. And many of you are probably asking, why? Contessa Brewer follows the insurance industry and joins us now. It's a big story.
You have questions. I have answers. I
Let's
cover
hope.
Insurance. So I hear it all the time, the shock and the awe when people open the bill for their insurance premiums. They're getting sticker shock, and CPI bears it out. It does not break out home or renter's insurance, but auto insurance up 22.2% over March of last year. And since February alone, prices jumped 2.7%, so almost 7 times higher than the broader inflation reading. Insurers are paying out more on claims, though. Motor vehicle repair, look at this one. It jumped 3.1% over the previous month. Car and truck rentals up 5.7% in a month. But you know who likes higher insurance prices? Investors. While the rest of the market slumped today, look at shares of Progressive up, still less than 1%, up a little more than 0.5%, but still in the green. Allstate up 0.8%. Travelers up 0.25%. And more broadly, Arch Capital, Hartford, W. All Berkeley all ended the day in the green. Property insurers, of course, are facing many of the same issues, though higher prices for repair and replacement, a significant challenge with the amount of lawsuits filed and the costs of settlements and verdicts. And then there's the regulators in every state, some of whom have been very slow to approve rate hikes that match what the insurers are paying in loss costs. So the head of the trade group that represents property and casualty insurers told Squawk Box this morning, there is a long way to go before there is some kind of parity between what gets spent on claims and what's being brought in premiums.
It's a weird thing because, a lot of people on Twitter, X, whatever, they'll say, well, the insurance companies' stocks are soaring. They're printing money. And some are, mostly in the car side. Progressive, their stocks are up. But at the same time, State Farm and a bunch of other home insurers are getting their credit ratings cut.
The insurance industry as a whole has seen their credit ratings downgraded. And part of that is because climate risk is volatile and unpredictable. $100 billion in insured losses last year. It's the 4th year in a row that that's happened. And half of that was from thunderstorms in the United States. That is just very difficult even to model that kind of insured losses based on thunderstorms and hail and things like that. They're all covered perils. And they didn't reach a level, any single event, where reinsurance would have kicked in. So that's, for one thing, climate change. For the second thing, the regulatory risk and the litigation. Those are real expenses. But the other thing is for years, they have not been bringing in the premiums that matched what they've been paying. And so this is lagging.
Dang.
And
They've been losing money. In other
and
words.
what we're going to see, yes, but well, they've been making money. Chubb had a record year last
State
year.
Farm losing billions. About, you know.
Allstate, which is publicly traded, has had a really tough year because of what they've been paying out. But the trend is that the rates are going higher, and a lot of the insurers, I'm going to use Chubb as an example, it has managed its risk differently. So it's not so exposed. It has invested differently, and it's making a lot of money on its investments. And that's why those insurance stocks are still going up. Plus, and the investors think, we're in an upward trajectory with rates. This is going higher.
Well, and it's an important thing for people to understand. They just assume that Chubb is making all this money because they're, you know, I was going to. Anyway, you get what I was about ready to say. You know, fleecing.
Right.
I was trying to find a family-friendly word, but what they're doing is that they're getting out of riskier areas. Right? I grew up in Southern California, okay?
Right.
And there's a hill behind me that used to burn every 3 years. It caught on fire every 3 years, just catch on fire. Now there's homes. The whole hill is houses.
And some of them very expensive houses.
Yes, it's
Some of them.
more expensive.
million plus. I'm like, every 3 years that hill used to catch on fire randomly.
And so now what happens is you either have to go to the state insurer of last resort and pay a lot of money for not enough coverage, or you go to an excess and surplus line, which Chubb still offers, but you're going to pay through the nose for it.
And
it's an issue, you guys, and that same thing is happening to property taxes. And I just made a video on this, and this is a huge problem going on around the nation, is the appraisal districts are over assessing properties, and they're over assessing these properties by a significant amount. It is all over the place in my local housing market. Some of these assessment values are over $100,000 over the actual market value, which means we're getting robbed by the county because we're paying on taxes on something that's not worth what they're saying it is. And so, you guys, that's why I keep saying protest, protest, protest. They will tax you like crazy if you let them, right? If you let them. Now, I have another question coming up, all right? So I want everyone to be ready. I want the realtors to be ready, okay? I mean, if you're a realtor, you're listening to this, imagine being the first realtor to win, right? Especially if you want to promote your business. Don't you want to be the realtor that got right when there's no other realtors? We only got 2 questions left, realtors, okay? I'm going to throw this chart up, okay? So the question is this. Get ready, okay? Get ready. You guys ready? I'm going to throw this up. It's going to be quick, okay? When we look at this chart, all right, and this is a quarter over quarter. This is median sales price of houses sold in the United States. This is quarter over quarter. Why does this show a decline? Why does this show a decline? Remember, house values are up, right? We have a new record house values. Is that correct, guys? Don't we have new record highs? But this says actually house values have been going down since Q4 of 2022. Why? Why does this data, and you guys see how nice I am, I very rarely quote this data. Very rarely do I do it because it's a big picture. No. Why is this going down? This is median sales price of houses sold in the United States. Why is this going down, guys? Come on, anyone? Come on, realtors. Nope. Yep. My man, yes. Okay. So proud of you for listening. I'm so proud of you. So proud of you. Austin with another one. All right, guys. So here's the thing. He's 100% right. This is the reason why this is going down is because this data includes all data. This data includes new homes as well. So we all, what do I, you know what I hear a lot? I hear, Travis, you're crazy because new homes only account for 15% or 20% of total sales. And I'm like, well, if it wasn't a big deal, then this wouldn't be plummeting, bulls, you fools. They're like, it's only 15%. Well, then why is that plummeting? When you add it together, it's going straight down. It's going straight down when you add it together. Come on. Well, not straight down, but you guys get what I'm saying. It's continuously going down. The reason why you see that is because it's adding new homes to the mix. If you want to see the big picture, this is what you look at, because what happens when a new home is sold? What happens to a new, and this is not a question, but it is a question, but not for trivia. What happens when a new home sold? It turns into an existing home. The moment the new home sells, it turns into existing home. So why do people leave it out of the data? It's no longer new, it's an existing. And so again, when you add that here, the median sales price keeps going down, bulls. So I'm interested, I want a bull to explain this. Again, if new homes, it's not that much the equation, it's just a small piece of that pie. Well, actually, it actually is a big piece of that pie, because when you add it to the pie gets moldy, it gets toxic, it gets dirty. Anyways, we're going to go into our recession and liquidity. I apologize for that. Got a little kooky there for a minute. We're going to go into our liquidity and recession stuff now, guys. And then I think we got one more question as well. I'm going to start here. This is the 10 and the 2. This is why we're not lying, right? This is a huge thing right here, right? This is what we stand on as bears. This is what this is one of the main things. Scrog, I miss you, dude. Come back to Discord, bro. Scrog, you bought a house and you ditched us, man. My man Scrog ditched us. I miss you, Scrog. Why you ditch us? Anyways, guys, here's the thing. This is the 10 and the 2. This is the warning sign a recession's coming. And now I want to point out that we've actually been stuck in the 30 basis point range for 2 months. We're basically stuck here. Look at this. So we have been stuck inverted. We've been, we started inversion. The first inversion was April 1st of 2022, which means we've been over 2 years since the date of the original inversion. So we've been inverted for over 2 years, which makes sense because of the amount of money printing. But this is a huge warning sign, guys. We're stuck. It's like we're stuck in the 30s. This is crazy. Look at this. We're also stuck here. We've been stuck in the reverse repo market as well for 2 months. So we're stuck in the 2 and the 10. We're stuck in the reverse repo market. The reverse repo market, it just updated. It's sitting at 455 billion. This is the sum of the inflation. Okay, let's just call this inflation instead of liquidity. But this is liquidity, but let's just call it inflation. So here's the inflation. It's stopped going down. It's been sideways for 2 months. That's pretty surprising to me. I thought this would be gone by the end of May. It's not looking like that, because look at how long it's been basically sidestepping. 2 months sidestepping. Very interesting. Now, take a look at this. Okay, here's the Treasury General Account. This is more inflation. Okay, this is just money that they have. Now, this has been impressive. So they're sitting at 704 billion. It's been this way for about 6 months. There you are. I see you. It's been this way for about 6 months. Okay, so there's still inflation. They still have money, but this next thing I'm going to show you guys, this next thing's real bad. You guys. Look at this. The deficit updated. Okay? Year to date, deficit spending, 1 trillion with the T. So far this year, the government, and this just updated this morning, finally, okay, for March, $1 trillion in deficit spending. That's insane. Now, the good news, though, is it's down 3% year over year. Okay. And now what I like to compare, people are like, why is it taking so long? You were wrong. You're always wrong. You've been saying this for years. First of all, those people are not even listening. But you guys, here's the government deficit spending. We didn't even start significant deficit spending until 2008. Okay, we're doing significant deficit spending right now. Now, here's what I want to show you guys. Let's adjust this, and this is a big shout out to Mr. Watson. We're going to adjust this for inflation. So remember, in 2009, there was $1.42 trillion in deficit spending. So let's figure out what that equals adjusted for inflation, and let's see how it compares. So when I put 1.42 here, let me change this to 2008. Actually, 2008. So I'm going to calculate. So let me move my picture. Sorry, guys. So 1.42 trillion back then equals today 2.11 trillion. Okay, so let's go back here. Look at this, 2.11 trillion. So they spent more adjusted for inflation. So we'll adjust for inflation. They spent more in 2021 than during the GFC, and way more, 50% more in 2020. But like, my thing is why did you, like, here's the really caught me off. Like, I really thought, you guys, that we're going to go into 2023 with deficit spending going down. You see here the pattern during the last recession. First of all, we're not even in recession, but you saw the last pattern here where deficit spending goes down. But what's happened is it's been going up, and that really caught me off guard, because why the hell are they doing that in 2023? Anyways, guys, it is updated. Just wanted you to know that. Now take a look again. There's you. If you guys want, again, Mr. Watson, big shout out. If you guys want to see like crazy numbers, here's a CPI inflation calculator. Okay, now take a look at this. Here's real M2. Okay, so this is going back into quantitative tightening. Real means adjusted for inflation. So that's why Jeff is like, we're going to have a real crash, but a nominal crash in house prices, we're not going to have. Because nominal is just the numbers. Real is always adjusted for inflation, which we're all kind of looking at nominal. I get it. But regardless, you guys, real M2 has been going down since 2021. I mean, it's been going down for 2 years. Okay. So M2 is going down. Quantitative tightening is working, but again, they're still printing money. So it's like it's working, but it's also not working at all. It's like a messed up situation. Now, when we remove the real and we just look at M2, again, remember, M2 has been going down for the last 2 years, and this is the first time since the Great Depression. This is the data. We're not using emotions. This is data. Now, interestingly enough, it did go up in October to about January and then started kind of going down sideways. It's just so interesting to watch this. This is crazy. But take a look at this, guys. Here's the thing, okay? I don't think this is sustainable. I just don't think it's sustainable because at the same time that we have massive asset prices blowing up, breaking fundamentals, breaking any type of sustainability, income didn't go up. If income went up at that same pace or near the pace, then maybe we would be able to get to a soft landing, right? But here's the big thing, okay? And this is just my opinion. The story is being playing out. I'm just letting you know this is why I think what I think, and I have the data here to show you, and it will be linked. But real, adjusted for inflation, again, real median income has been going down since 2019. But again, this is adjusted for inflation, so we get that, right? But again, real median income going down at the same time that savings is plummeting. Before we were in lockdowns, our saving rate was double almost. It was 7.1 in June of 2019. So before lockdowns, we were saving at a rate of 7.1. You guys, now it's 3.6. So we're losing income. We can't save. We're saving at half the rate, okay? And all of that's going on. Meanwhile, consumer, which by the way, credit card debt is some of the worst possible prison debt you can get yourself into. It's like a prison. It's very hard to get out of, but that has been skyrocketing. Okay, so all these things are happening, but on top of the debt skyrocketing, so is delinquencies. Now, it's not at GFC levels. It's way past pre-pandemic, though. Way past pre-pandemic. Not at GFC levels, but all of this is bad. This is why I'm saying this is not like the 70s and 80s. This is not like the 70s and 80s. Let me throw up the VIX. I'm getting some chatter about the VIX. Let me throw it up, show you guys what's going on with the VIX. This is pretty insane. I was trying to invest in this. I didn't end up doing it when it was like at $12. I mean, dude, this is all over the place. This is the VIX. This is a volatility index. This is skyrocketing right now. Why? Why is it skyrocketing, guys? Maybe the market's starting to price in some turmoil. I don't know. So anyways, we're going to go into our last video, okay, which is Homebuilder Sentiment. It's only 2 minutes. Sentiment, because we're going to go to the bottom of the ocean. It's not sentiment. It's sediment. Okay, so Homebuilder Sentiment. I'm joking. Calm down. Okay, grammar police, calm down. I know there's the grammar police out there. Last question. Realtor, I want you to get this right. Here's our last trivia question. Okay, then we're going to go into our last video. Last trivia question. 3 categories to improve your purchasing power. What are the 3 categories to improve? My hands are like peeling. To improve your purchasing power. What are they? Realtors, come on, realtors. I didn't think I'd be gunning for you, but I'm actually rooting for the realtors right now to get this. What are the 3 things I've been telling you guys to work on for your purchasing power? Realtors should know this. Just give me one realtor. My man Sheldon just crushed it. Literally crushed. Y'all can't compete with the real estate mindset crew. We're too into data. We got boots on the ground across the nation. We got Raymond, we got Jeff, we got Johnny, we got Charles, we got Christy, we got Austin. We got Don't Move to Texas. We got a community going on right now in Discord, and they are sick. You guys are great buyers. I am proud of you, Sheldon. I am proud of everyone. Good job, man. And Trey, I'm definitely proud of you, Trey. Trey's my buddy. Good job, man. So just to let you guys know, the score is 7-0. Now, I know there's not as many realtors on. I get that, but dang, I was hoping the realtors would get at least one. We're going to listen to our last video right now, you guys, and then we're going to do some Q&As. Trump media share price drops below 30. Okay, that's interesting. Why did that come up? It's weird. Okay, so here's our next video about Homebuilder Sentiment. Just kidding, sentiment.
Well, mortgage rates are back over 7%, and today's reaction from the CPI number will only push them higher. That's hitting the real estate stocks across the board. Diana Olek joins us with more. Here we go again, Diana.
Here we go, Sarah. Yeah, the yield on the 10-year just took off this morning, and that's the measure that mortgage rates loosely follow. The average rate on the 30-year fixed crossed over 7% on Monday, and while we don't have today's rate yet, that's coming in about an hour, I'm told it will likely get close to 7.3%, and that would be the highest level since the end of November. It had crossed over 8% in October briefly, which was the highest in a few decades. Now, the home builders are taking it on the chin. The home construction ETF, that's ITB, falling below its 50-day moving average, down over 3% on the day, still up 6% year to date, though, and a whopping 57% year over year. Just to note, ITB includes not just the home builders, but home remodeling names like Lowe's, Home Depot, and Sherwin-Williams. Now, big builder names like D.R. Horton, Lennar, and KB Home are all dropping below their 50-day average. And of course, mortgage names like Rocket and United Wholesale Mortgage, Rocket down 10% on the day. And I would also note that REITs are also having a particularly rough day across all sectors. After outperforming yesterday, REITs are particularly rate sensitive, given how commercial real estate is, of course, financed. Back to you guys.
Diana, there had been some talk out there. You're seeing some activity levels rise off the lows recently that maybe the home buying market would just become a marginally less rate sensitive, whether it's because time has passed, prices adjusted, incomes have been rising for a while. Do we have any evidence of that, really?
No, in fact, I would say that people have gotten used to the 6% level, but I'm really seeing that 7% is that emotional divide where we saw it go over 7% back in January and February, and home sales took a hit. We're also not seeing any easing on home prices. So you still got a very expensive market. And when you start getting well over 7%, it's not just that monthly payment that it's hitting, but some people just don't qualify for a mortgage over 7%.
We also have one good thing going on, just depending on what side, excuse me, of the coin you're on. So not only do the 7% we also have an increase in inventory by about 23%. So we have inventory, and I just read a tweet. I haven't confirmed this yet. It was from Darth Powell. If you guys are on X, you guys probably know who that is. But he just said that Florida just got back to pre-pandemic inventory. I got to check that out. I'm not sure if that's true, but thank God we got inventory. We got high rates. We are sitting in a good position right now. I want to throw up some comments real quick. Let's see here. From Ima Day. Ima, thank you for being a part of the community and for always on, in the comments saying good stuff. Looks like she's playing some slot games. I see from your profile picture you'd be playing slot games. As long as it's fake, you're okay. Okay, don't be gambling, Ima. Don't be gambling. Okay, don't be gambling. We're in the front of a recession. Unfortunately, people will keep spending. That better not be real gambling. People spending on credit until they have no more. When this stops, that's when the real poo-poo hits the fan. Now I have a new saying for this. Okay, you ready for it? This is our new saying. Spend to the end. Spend to the end. I'm just going off of what happened last time. That's what happened last time. That's what I did. I'm just for myself. I spend to the end, and then I lost everything. I still can feel that pain. It was very painful. Jeff M., this is my buddy right here. You need to create your own housing crash. Now, this is what he means by that. Okay, now again, it's okay. He has his own beliefs. This guy's a good guy. He's in a tight market. He keeps us strong. He got he got $50,000 off on a house, right? By doing a love letter. So very, very sharp young man. Stop going on vacation. He's more right than I am. Stop going on vacation. Stop getting Starbucks. Meal prep 18 of your 21 meals. Do that for 5 years. Housing prices just crashed probably 30% for you. What he's saying, like if you really look into what he's saying, and I'm going to just support him on this because most people are not us. Most people are recklessly spending. He's saying, stop chasing a lifestyle that is there just to make you spend money. Rebudget, save your money. Don't go out to eat, cancel your subscriptions, sacrifice, and you can get ahead. Jeff, is that what you're saying? I don't want to put words in your mouth. And you know what, darn it, I am 100%. First of all, regardless, though, I still think the house market is going to definitely price correct and definitely crash 15% or more in many areas. But nevertheless, his point actually is stronger than mine because America has a bigger spending problem than house prices right now. In fact, if we didn't have a spending problem, house prices wouldn't be where they're at right now. Agreed? All right, next thing here is from my man Sheldon. Fed is in a tough spot and should be higher, but cannot due to debt payments and higher disaster in banks. And here's the thing that I want to tell you guys, something that I have been really coming to the conclusion of. the balancing act from Jerome Powell. So basically, if he goes too high on the interest rates, he crashes the banks and he has to stop. And so really it's kind of a balancing. And that's why I did a video with Orlando and I was like, can CRE, commercial real estate, make it through 2024 without a collapse? As long as it can make it through 2024 without a collapse, we should be fine. My worry is something is going to collapse that's not going to help consumers and they're going to have to cut rates. And that's what we do not want. So we don't want commercial real estate to collapse right now. Next thing is this is from Ruben. Right now, it makes 0 cents to buy. 0 in my area. The same apartment cost $1,000 to $2,000 lower to rent versus buy, and that assumes 20% down payment that people cannot make. So let's go into the advantages of rent. Now, normally, historically, renting not always a good idea, right? And that's why it drives me so crazy that I'm in this situation that I'm in because I don't want to be renting right now. But regardless, so look at what he's saying. So he can save $1,000 to $2,000 extra per month by renting. People are like, what do you get from renting? Well, I get to save $1,000 to $2,000 extra a month. What do you get? A bill from your homeowner's insurance going up? That's what you got. I didn't get that. I got savings. Okay. Plus that 20% down payment. Say the house that you want is $400,000. 20% is 80 grand. If I take 80 grand of my money and I put it in T-bills, I get what? What's 80 grand times 5? $4,000 a year. So I also get income on top of that back from my down payment. So there's benefits in renting, okay? Thank you, Ruben. Here's my man, Owen. Owen, homeowner versus renter, what's the difference? Well, there's a lot of difference. Let me tell you this. Let me be optimistic. No. To be realistic, and this is why I love real estate, in a healthy market, not this market, in a healthy market, not this market, homeowners generally are better off because you pay your debt down. You generally will get appreciation, meaning the value will go up. And also I get to deduct the interest, and that tax deduction allows me to break the standard deduction. So there's benefit in being an owner versus renter. The advantage of being a renter, you don't have to care about the property. If the roof flies off in a hurricane, you don't have to pay that 5% deductible. Your landlord does. The advantage is basically you can move. You're free to move anywhere. But again, you're not. It's how you rent that matters. I worry that some people are renting and still living a party type of lifestyle. You don't want to party in the front end of a recession. You want to save your money in the front end of a recession. So I think what I'm saying is like right now, renters are winning. But like before lockdown, 100% owners, 100%. I love real estate. I was helping people 2020, 2021. I got out of the industry in 2022. Okay. And I just kind of dabbled back into it again. But right now, man, renters win. I mean, I don't know how else to say that. And yes, we just covered that. So anyways, guys, I think is that it for the comments that I have here? I think that's it. All right, guys, I'm going to get out of here. I just wanted to say this final thing real quick. I want you guys to have a great weekend. I will try to be back on Tuesday. Please support me, you guys. These trips cost me so much money. I mean, not only does it cost me money, I lose money as well because I can't do as many videos. So please support me. I'm going boots on the ground, eyes on the sky for you guys. I'm leaving on Saturday. Really looking forward to that. So please, again, just watch those videos. Share the videos. Always comment as usual. And again, next live, I want the realtors to step up. You guys smoked them. Proud of you guys. Okay. So keep listening, keep empowering yourself. Remember this. Okay. No one cares about you like you. Don't forget that. See you later.